Greetings, everyone. My name is Kyle McLean, and I'm a partner and senior wealth manager here with Rhame Gorrell Wealth Management. Today, we'll be covering one of my favorite tax strategies within the ExxonMobil benefits, the Mega Backdoor Roth. This strategy gives ExxonMobil employees a way to turbocharge tax-advantaged 401k savings beyond normal IRS limits. If you or someone you know could benefit from this strategy or from the other services our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. Without further ado, let's jump into today's topic, the Mega Roth. So, what is the Mega Roth? At its core, the Mega Roth is a tax strategy embedded within the ExxonMobil 401k. By undertaking a series of transactions, employees can make contributions beyond normal IRS limits. For instance, in 2024, employees can contribute $23,000 either via pre-tax or Roth contributions, with a catch-up contribution of $7,500 available if you'll be 50 years or older by the end of the year. The Mega Roth allows certain employees to add tens of thousands of additional dollars beyond that limit to the plan annually. I'd like to take a moment to refresh everybody's memory on how pre-tax versus Roth contributions work for tax purposes. As I previously mentioned, for 2024, employees can contribute $23,000 to the pre-tax or the Roth account, or some combination of the two. Pre-tax contributions, as we may know, involve making contributions before federal income taxes are paid. However, all of your contributions, as well as your growth, are taxed upon distribution. Roth contributions, on the other hand, are made after federal income taxes are paid, and all of your future growth, as well as your original contributions, are tax-free upon distribution. The determination of whether an employee would want to make pre-tax versus Roth contributions is entirely dependent upon their current tax rate versus their anticipated future tax rate. If you'd like a deeper analysis of this topic, please see our pre-tax versus Roth contributions video. Concurrently with your pre-tax or Roth contributions, the company will be making a 7% matching contribution to the general account, which is also classified as pre-tax. Based on the contributions discussed above, the total going into the 401k for an individual maximizing the pre-tax contribution and making $300,000 a year is $44,000 from a combination of the employee and ExxonMobil contributions. This $44,000 total is well below the IRS maximum contribution limitation for all sources of contributions. This limit is $69,000 for those under the age of 50 and $76,500 for those over the age of 50. So, where can this $25,000 difference between the IRS limit and the other maximum contributions go? You guessed it, it's the after-tax account. Let's discuss the tax features of the after-tax account because they're a bit of a blend of the tax features of the pre-tax and Roth accounts. After-tax contributions, as the name implies, are made after federal income taxes have been paid from the funds. However, growth that occurs while in the after-tax account will eventually be taxed as ordinary income upon distribution. So you might ask yourself, why would I contribute to an account with no current tax bill reduction, but all of my growth will eventually be taxed as ordinary income? It's because we will not leave the funds in the after-tax account to grow indefinitely. The ExxonMobil Savings plan allows participants to convert these after-tax funds to Roth. And the best part? If funds are converted to Roth before growth occurs, the conversion is entirely tax-free. Here's how it works. Once the normal pre-tax or Roth limit for contributions is reached, the employee may defer additional funds into a third repository within the plan, which is called the after-tax account. Subsequently, these additional funds are converted into the Roth conversion account, where you will enjoy tax-free growth until these funds are distributed during your retirement years. At this point, we hope it's becoming clear that this strategy can be an absolute tax home run for retirement savers. It's also important to note that most 401k participants outside of ExxonMobil cannot use this strategy. While some large companies do have this capability, if you look at all eligible 401k plans across the US, only about 30% offer the Mega Roth. So let's consider a comparison of an individual who fully utilized the Mega Roth strategy over the course of their career with $1 million of earnings within the Roth conversion account, versus an individual who alternatively diverts these funds into a brokerage account, for instance. Given that the Roth earnings are tax-free, while the brokerage account earnings will generally be subject to a 15 to 20% tax rate on long-term capital gains and an ordinary income rate of up to 37% on interest income or short-term capital gains, the differential is at a minimum several $100,000 of needless taxes paid. Before we wrap up our conversation today, I'd also like to draw your attention to a few important considerations surrounding the Mega Backdoor Roth strategy. If you have a pre-existing after-tax balance within the savings plan or growth on recent contributions, you should be aware of the Pro-Rata Rule. The Pro-Rata Rule states that if an after-tax account contains a mix of contributions and taxable earnings on those contributions, any conversion or distribution from that account will be partially taxable depending on the ratio of contributions to earnings. These numbers are different for everyone, so we absolutely recommend that you discuss the effect of any current balance that you have within the after-tax account with a tax expert like ourselves who can help you understand the tax implications of any future conversions. Another factor worth being aware of is the conversion limitation. ExxonMobil only allows for one in-plan conversion each calendar year from the after-tax account to the Roth account within the savings plan. This is an Exxon rule, not an IRS rule. In some cases, it can make sense to execute a partial rollover distribution of your after-tax account to outside IRAs. This can be done up to twice a year, but the in-plan conversion can only be done once per year. So you want to make sure that you use that conversion wisely. The final thing that I want to touch on is something that many ExxonMobil employees aren't even aware of. For individuals that we talk to later in the year or at the mid-year point who have not started their after-tax contributions, the ExxonMobil Savings Plan does allow for a special one-time after-tax contribution. This allows the individual to write a personal check and to submit it alongside a form to the savings plan to fill up the after-tax bucket. This can be particularly useful for employees looking to accumulate those additional tax-advantaged retirement savings, but have not reached the IRS limit for total employee and employer contributions, which, as we mentioned before, is $69,000 in 2024. Thanks again for spending some time with us today to learn about the Mega Roth strategy. As a team, Rhame Gorrell Wealth Management serves roughly 400 families across the United States, as well as expats abroad, and we provide advice on over $1 billion in client portfolios. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA tax professionals on our staff specialize in helping our clients take advantage of advanced financial strategies to materially enhance their financial ability to enjoy their lives, both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.